Hey everyone, welcome back to the Deep Dive. You know, when you start exploring the world of trading, it doesn't take long before you bump into these things called trading indicators. They're basically tools, analytical tools, that people use to try and figure out what's going on in the market. And today, we're going to take a real deep dive into them using this essay by Jörg-Owe called Trading Indicators for Beginners as our guide.
Yeah, it's a really interesting piece, especially for anyone who's just getting started with technical analysis.
It is. So we'll be focusing entirely on Schneppat's insights today and really trying to break down what these indicators are, the different types, how they work, and what their strengths and weaknesses are.
Right. Schneppat kicks things off by talking about how trading indicators are like tools in a toolbox. Each one is designed for a specific purpose.
That's a great analogy, like you wouldn't use a hammer to tighten a screw, right?
Exactly. You need the right tool for the job.
Okay, so let's dive into these different tools. Schneppat starts with trend indicators. Now, trend indicators, as the name suggests, are designed to help you identify the direction of the market.
Yeah, and not just the direction, but also the strength of that trend.
Right, because a strong trend is more likely to continue than a weak one. At least that's the idea.
That's the thinking. And Schneppat mentions a few examples of trend indicators, like moving averages, MDD, and DMI.
So if you're looking at a chart and you're trying to figure out if a stock is in an uptrend or a downtrend, these are the tools you'd use.
Exactly. Let's say you're using a moving average. Instead of looking at the price of a stock every single day, which can be super noisy, a moving average smooths things out by averaging the price over a certain period.
Okay, so it gives you a kind of a bigger picture view of the trend?
Exactly. And then you have the MATD, which stands for Moving Average Convergence Divergence. This one's a bit more complex, but it basically looks at the relationship between two different moving averages to try and give you even earlier signals about potential changes in trend.
I see. So it's like a trend indicator on top of a trend indicator?
Kind of. And then you have the DMI, which stands for Directional Movement Index.
Yeah.
This one actually measures the strength of a trend, so it can help you see not only which way the market's moving, but also how much conviction there is behind that move.
Gotcha. So trend indicators are all about identifying and measuring the direction and strength of market trends.
Precise.
All right. Now, Schneppat also talks about momentum indicators. These seem a bit different because they're not so much about the direction of the market, but more about the speed, right?
Absolutely. Momentum indicators measure the rate of change in price, so they can tell you if a move is accelerating or starting to slow down.
Okay, so like a speedometer for the market.
Perfect analogy. And Schneppat gives a few examples here, like the RSI, the stochastic oscillator, and the ROC, which stands for rate of change.
Let's break those down a bit. What's the RSI all about?
The RSI, or Relative Strength Index, looks at the size of recent price gains compared to recent price losses. So if a stock has been making big gains day after day, the RSI will start to rise. And if it rises above a certain level, it might signal that the stock is getting overbought.
Meaning it's gone up too far too fast and might be due for a pullback.
Exactly. And the opposite is true too. If the RSI falls below a certain level, it might signal that the stock is oversold.
Okay, makes sense. Now, what about the stochastic oscillator? That one always sounded kind of intimidating to me.
It's not as complicated as it sounds. The stochastic oscillator basically compares the current closing price of a stock to its trading range over a recent period. If the closing price is consistently near the top of that range, the oscillator will signal overbought conditions, and if it's consistently near the bottom, it'll signal oversold.
Interesting. So it's kind of like a different way of looking at overbought and oversold conditions.
That's right. And then you have the ROC, which is just a simple measure of how much the price has changed over a specific period.
Yeah.
It's basically looking at the percentage change in price.
Gotcha. So if a stock is up 10% in the last month, the ROC would be 10%.
Right. And that would tell you the stock has had some pretty strong momentum.
Okay, cool. Now, Schneppat also briefly mentions a few other common momentum indicators like the CCI, the Williams-Bursar, the Awesome Oscillator, and the Klinger Oscillator. I'm not sure we have time to go into all of those in detail, but it seems like there's a whole arsenal of tools for measuring momentum.
Yeah, there are a lot of different ways to look at it. Each indicator has its own nuances and its own way of calculating momentum.
Oh, okay, fair enough. Let's move on to the next category, which is volatility indicators. Now, volatility, if I remember correctly, refers to how much the price of an asset tends to fluctuate, right?
Exactly. A volatile asset has big price swings, while a less volatile asset has smaller price swings.
Right. And Schneppat mentions two main volatility indicators, Bollinger Bands and ATR.
Yeah, those are two of the most popular ones. Bollinger Bands are basically bands that are plotted around a moving average.
Okay, so you have the moving average in the middle, and then you have these bands above and below it.
Right. The bands are typically set 2 standard deviations away from the moving average.
So as the price of the asset gets more volatile, the bands widen.
Exactly. And when the price becomes less volatile, the bands narrow.
I see. And traders use this information to, identify potential breakouts or reversals?
That's one way to use them. When the price breaks out of the bands, it can signal that a new trend is starting. And when the bands are very narrow, it can sometimes indicate that a big move is coming soon.
Gotcha. Okay, now what about ATR? What does that stand for again?
ATR stands for average true range.
Right. And what does it measure?
It measures the average size of the price swings over a certain period.
Okay. So if the ATR is high, it means the price has been moving up and down a lot.
Exactly. And traders use the ATR for a lot of things, like setting stop-loss orders and determining position sizes.
Right. So if you know the average price range of an asset, you can set your stop loss a reasonable distance away from your entry point.
Precisely. You don't want to set it too tight and get stopped out prematurely, but you also don't want to set it too wide and risk a big loss.
Gotcha. So volatility indicators are all about understanding how much an asset's price tends to fluctuate.
Right.
Okay, let's move on to the next category, which is volume indicators. Now, volume indicators take into account the number of shares or contracts traded to try and gauge the strength of a move.
Exactly. Volume can tell you a lot about the conviction behind a price move. If you see a big price increase on low volume, it might not be as sustainable as a big price increase on high volume.
Right, because high volume suggests more people are participating in the move.
Exactly. And Schnepphat talks about a few different volume indicators like on-balance volume, volume rate of change, and the accumulation distribution line.
Let's start with on-balance volume, or OBV for short. How does that one work?
OBV tries to track the flow of money into and out of a stock by looking at the relationship between price and volume.
Okay, so if the price goes up on high volume, OBV increases.
Right. And if the price goes down on high volume, OBV decreases. The idea is that if OBV is rising, it means more buyers are coming into the market, which is a bullish sign.
Gotcha. And what about volume rate of change? What's that one all about?
Volume rate of change simply measures the percentage change in volume over a certain period. It's basically looking at whether volume is increasing or decreasing.
So if you see a sudden spike in volume, it might signal that something's happening in the market.
Exactly. It could be a breakout, a breakdown, or some other significant event.
Okay, and then we have the accumulation distribution line. What's that one trying to tell us?
The accumulation distribution line is similar to OBV, but it's a bit more nuanced. It looks at where the price closes within its daily range and uses that information to estimate the flow of money into and out of a stock.
Interesting. So it's not just about the total volume, but also about where the price closed relative to its high and low for the day.
That's right.
Okay, so volume indicators are all about trying to get a sense of the conviction behind price moves.
Exactly.
And they can be particularly helpful in confirming or invalidating signals from other indicators.
Absolutely.
Now, the last category of indicators that Schnepphat discusses is oscillators. He actually brings back a couple that we've already talked about, stochastics and CCI. But he explains that oscillators are generally bounded within a certain range, which makes them particularly useful for identifying overbought and oversold conditions.
Yes, that's a key characteristic of oscillators. They tend to oscillate between a high and a low, which can give you visual clues about potential turning points in the market.
Okay, so if the oscillator is near the top of its range, it might be a sign that the market is overbought and due for a pullback.
Right. And if it's near the bottom of its range, it might be a sign that the market is oversold and due for a bounce.
Makes sense. And this can be especially helpful in range-bound markets, where the price is just moving back and forth between certain levels.
Exactly. In a trending market, you might be more focused on trend indicators.
Yeah.
But in a range-bound market, oscillators can be very useful.
Gotcha. So oscillators are all about identifying those extremes in price action, those overbought and oversold conditions.
Precise.
Okay, so we've covered a lot of ground here. We've talked about trend indicators, momentum indicators, volatility indicators, volume indicators, and oscillators. And we've talked about how each type of indicator can give you a different perspective on the market. But the big question is, how do you actually use all of this information to make trading decisions?
That's the million-dollar question. And Schnepphat emphasizes that you can't just pick an indicator at random and start trading. You need to have a plan.
Right. You need a trading system.
Exactly. And a trading system involves a lot more than just picking indicators. You need to define your entry and exit rules. You need to have a risk management plan. You need to know what kind of markets you're going to trade. And you need to have realistic expectations about what you can achieve.
And this all starts with developing a trading plan, right?
Absolutely.
Yeah.
A trading plan is like a roadmap for your trading journey. It lays out your goals, your strategy, and your risk management rules.
So it's basically a document that outlines everything about your approach to trading.
Precisely.
Okay. And once you have a trading plan, you need to test it, right?
Yes, that's called backtesting. Backtesting involves applying your trading plan to historical data to see how it would have performed in the past.
So you're basically simulating trades to see if your strategy would have worked.
Exactly. And this is a crucial step because it can help you identify any weaknesses in your plan and make adjustments before you start trading with real money.
Gotcha. So backtesting is all about validating your trading plan and making sure it has a statistical edge. Okay, and once you've backtested your plan, you can start thinking about combining different indicators, right?
Yeah, combining indicators can be a powerful way to improve the reliability of your trading signals.
Because if you have multiple indicators all pointing the same direction, it increases the probability that you're seeing a real opportunity.
Precisely. It's like getting confirmation from multiple sources.
Gotcha. And Schneppet mentions that combining trend indicators with momentum indicators can be particularly effective.
Yes, because trend indicators tell you the direction of the market, while momentum indicators tell you the strength of the move.
So you might use a trend indicator to identify an uptrend and then a momentum indicator to find a good entry point within that uptrend.
Exactly.
Okay, and finally, Schneppet stresses the importance of being able to read indicators properly. It's not enough to just know what an indicator is called. You need to understand what its signals are telling you.
Absolutely. Each indicator has its own unique way of signaling potential trading opportunities. You need to learn how to interpret those signals in the context of the overall market environment.
Right, because a signal that looks great in isolation might not be so great if you're not considering other factors like the overall trend or the volume.
That's right. You always need to be thinking about the bigger picture.
Okay, so let's recap. We've talked about the different types of trading indicators, the importance of having a trading plan and backtesting it, the benefits of combining indicators, and the need to be able to read indicators properly.
Yeah, we've covered a lot of ground. And I think it's clear that trading indicators can be powerful tools for traders.
They can be, but it's important to remember that they're just tools. They're not magic bullets.
Exactly. They can help you make more informed trading decisions, but they can't guarantee profits.
Right. And as Schneppet points out, there are also some limitations to trading indicators that traders need to be aware of. One of the biggest limitations is that they can be lagging.
Yeah, a lot of indicators are based on past price data, which means they can be slow to react to changes in the market.
So you might get a signal to buy after the price has already started to move up, or a signal to sell after the price has already started to move down.
Exactly. And that can be frustrating for traders.
Another limitation is that indicators can be sensitive to market noise.
Right. Minor price fluctuations can cause indicators to give false signals, especially if you're using a lot of different indicators at once.
And that can lead to confusion and bad trading decisions.
Absolutely. So it's important to use indicators wisely and not get too caught up in the short-term noise.
Okay. And one more limitation that Schneppet mentions is that the default settings on an indicator might not be optimal for your particular trading style or the market you're trading.
Yeah, that's a good point. You might need to experiment with different settings to find what works best for you.
Right. And that takes time and effort.
It does.
Okay, so we've talked about the benefits and limitations of trading indicators. Now let's shift gears a bit and talk about some common mistakes that beginners make when using indicators.
Sure.
Schneppet highlights a few big ones, starting with trading without a plan.
Yeah, that's a recipe for disaster.
It's like going on a road trip without a map. You might eventually get somewhere, but it's probably not going to be where you wanted to go.
Exactly. You need to have a clear destination in mind and a plan for how to get there.
And in trading, that means having a trading plan.
Precisely.
Okay, another common mistake is a lack of proper education.
Yeah, a lot of people think they can just jump into trading and start making money right away, but it's not that simple.
It's like anything else in life. If you want to be successful, you need to put in the time and effort to learn the ropes.
Exactly. Trading is a skill that takes time and practice to develop.
Right. And Schneppet also mentions ignoring economic news as a common mistake.
Yeah. Economic news can have a huge impact on the market.
So if you're not paying attention to what's going on in the world, you could be caught off guard by a sudden move in the market.
Absolutely.
Okay. And then there's overtrading.
Yeah, overtrading is a big problem for a lot of beginners.
It's basically trading too much, too often.
Right. And it can lead to big losses.
Because you're essentially racking up trading costs and increasing your risk of making bad decisions.
Exactly.
And related to overtrading is revenge trading.
Yeah, revenge trading is when you try to make up for losses by trading even more.
Which is almost always a bad idea.
It is. It's just emotional trading, and emotional trading rarely ends well.
Right. And finally, Schneepat mentions not using stop-loss orders as a common mistake.
Yeah, stop-loss orders are essential for managing risk.
They're like a safety net that can help you limit your losses on a trade.
Exactly. And if you're not using them, you're essentially trading naked.
Right. And that's a very risky proposition.
It is.
Okay, so those are some of the common mistakes that beginners make. Now, let's wrap things up by talking about some best practices for beginners who are just starting out with trading indicators.
Sure.
Schneepat recommends a few things, starting with engaging with the trading community.
Yeah, there are a lot of great resources available online, like forums and social media groups.
Where you can connect with other traders, learn from their experiences, and get different perspectives on the market.
Exactly.
He also recommends choosing the right educational resources.
Yeah, there are a lot of scams out there, so it's important to do your research and find reputable sources of information.
Right, and that might involve investing in a good trading course or finding a mentor who can guide you.
Absolutely.
Schneepat also reiterates the importance of developing a trading plan. We've talked about that a lot already, but it really is essential for success in trading.
It is. It gives you a framework for making decisions and helps you stay disciplined.
Right. He also recommends conducting thorough research and analysis before making any trades.
Yeah, you need to understand the market you're trading, the asset you're trading, and the indicators you're using.
And that takes time and effort.
It does, but it's well worth it in the long run.
And finally, Schneepat recommends practicing with a demo account before risking any real money.
Yeah, demo accounts are a great way to get familiar with the trading platform and test out your strategies without any risk.
So you can make mistakes and learn from them without losing any money.
Exactly.
Okay, so there you have it. A deep dive into trading indicators based on the insights of Jörg-Owe Schneepat.
Yeah, we covered a lot of ground today.
We did. And I hope it was helpful for our listeners.
I hope so too.
So to wrap things up, I want to leave you with this thought. Given everything we've discussed today about the power and the pitfalls of trade indicators, what aspect of market analysis will you focus on next to deepen your understanding of trading? Think about it, explore it, and keep learning.
And remember, it's a journey, not a destination.
Exactly. Thanks for joining us on the Deep Dive.
See you next time.